From the morning reading, IWM leads the indexes. NVIDIA spikes on strong earnings per share beat. Leads the SPX, NDX, and SOX. 5 of 10 sectors moved higher on Friday. XLY, XLK, and XLF were the strongest sectors, while XLE was the weakest sector. Oil futures fell $1.17 to close at $43.12. For the week ended November 4th, 7 of 10 sectors moved higher. XLF was up over 11%, XLI was up over 8%, XLV over 6%, XLY nearly 4%, as was XLB. The Spider was up nearly 4%. Sectors that were lagging were XLE up about 2.5%, XLK up a little over 1%, and then losers were real estate, XLRE, and XLP down 1 to 2%, and then XLU was the biggest loser of the week, down 4%. Breadth strengthened compared to the prior session as advancers led 1653 to 1397 on the New York Stock Exchange and led 1961 to 828 on the Nasdaq. Also in the morning reading, the S&P 500 snapshot, the election rally ends with a modest loss. The downtrend in the S&P 500 that started Thursday afternoon continued in Friday's open, with the index hitting its negative 0.69% intraday low near the end of the second hour of trading. The bounce that followed took the index to a relatively narrow trading range in the shallow red through the afternoon. A rise in the final hour raised the possibility that the pre-post election rally would extend to a fifth day, but it was not to be. The intraday high was a negative 0.07%, was close to logging day 5, but the session ended at 0.14% loss. The bond market was closed due to Veterans Day. Small caps ruled. The Russell 2000 index of small cap stocks rallied more than 10% in the week, its sixth best weekly gain ever. All the others occurred after the index had sold off, meaning that this was the best ever gain when closing at a 52-week high. Its previous best occurred in March 2000. There is some evidence that this blow-off kind of behavior, especially if we see sellers step in over the next 2 weeks. High-yield bonds didn't go along for the ride. Usually small-cap stocks and high-yield bonds move in lockstep as they are influenced by many of the same factors. Not so this week. The large gain in small-cap stocks was met with a decline in high-yield bonds, which has led to some underperformance in stocks, but not enough to suggest that the bond traders are infallible smart money. Copper suffered its worst ever reversal. After trading to a fresh 52-week high, copper futures fell more than 8% into the close, by far the worst rejection from a high in its history. Other large reversals led to weakness over the next month, especially in recent years. Crude oil's post-slump reaction has been flat. In the November 3rd report, we noted that after other times oil dropped 10% in 10 days from a high, how it reacted over the next week, 5 trading days, had a positive correlation to its returns over the next month. This time around, oil was exactly flat, closing at 44.66 on November 3rd and at the same price on November 10th. The 3 prior days were all higher, so we'd give the benefit of the doubt to the upside, but it certainly wasn't conclusive. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:22 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 14th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and bounce into the morning report. And at the time of this cut, the markets were mixed, and hadn't moved very much with respect to the four broad U.S. indices. The S&P futures were up just above scratch. The Russell was up about 1/3%. Nasdaq was down just below scratch, and the Dow futures were up about 1/3%. Crude oil, though, down big, down 1.43%. Euro down about 0.75%. Bonds down about 0.8%, and then gold down just below scratch. In overseas action, all the markets we follow were open. China was up about 0.5%. Hong Kong down about 1.3%. Japan down, make that up about 1.7%. Germany up about 0.4%. United Kingdom up about 1/3%. In terms of macroeconomic reports for today, with respect to the United States of note, there are none. In terms of looking forward to tomorrow, we have core retail sales and Empire State Manufacturing Index and import prices. So there are some reports for tomorrow. And looking at current volatility conditions, the crush was on during last week. Short-term VIX all the way down to a 12.84 already. Skew is also down below the caution line, so is now benign. IV percentiles have also been crushed with last week's activity, and the S&P is down to a 25, the Russell 25, the Nasdaq a 33, and the Dow a 23. In terms of standard deviation size moves for the four U.S. broad market indices, we only had one on Friday, and that was the Russell. And the Russell, indeed, as you heard from one of the morning authors, has had quite a move. In the last 5 trading sessions, you've had two standard deviation size moves to the upside and 1 standard deviation moves to the upside. So pretty significant action for small caps continuing through Friday. In terms of the current charts, let's go ahead and bounce over there. And here on the S&P chart, you see we have made the huge post-election reversal, moved up towards the area of resistance that we've been talking about for several sessions, and have basically consolidated in a sideways pattern. So what's important about that is perhaps 2 things. One, the resistance is still there until proven otherwise. Second, that we haven't fallen back from it. So we're pretty much in a status quo neutral zone, and pretty much towards the upper end of a large range. So that's kind of where we are until something moves us to one direction or the other. In terms of the Dow, of course, had the breakout, and not only had the post-election reversal, but went all the way through to the other side and confirmed the breakout, and has built on that in a subtle but important way with Friday's action. And then last night also set an intraday, or I should say an overnight, new 52-week high. And that so far, while it's backed off a little bit of that, and certainly the cash market's going to be important, it's still positive and is higher than Friday's close. So right now, the Dow continues to be the leader out in front. Another leader, of course, is the Russell. And the Russell had been so long, we had talked about the relatively weaker of the indices. Well, with the post-election results, the small caps have surged on that news. You heard one of the morning authors mention this as well. And it is also set a new overnight high for the 52-week period. So this is also building on its breakout. So we have at this point the Dow and the Russell at new 52-week highs, the S&P near 52-week highs, and then the Nasdaq kind of doing its own opposite thing, decidedly weaker. It was the leader in terms of going into the market as the most bullish, and has come out of the election results as the weakest. So we'll see where that goes. This was very strange action at the end of last week, and we talked about Amazon selling off quite a bit, Apple, Facebook, All the big tech stocks and so forth were selling off. Bottom line, the Nasdaq is decidedly weaker at this point. It's in the middle of its trading range, so overall, while weaker compared to the other three, it's in a neutral stance, just below the cloud, and it's been rotating right around a relatively thin cloud that is also relatively flat. So this is about as neutral as it can get, though certainly in contrast to the action of the other indices. So we'll have to see which one breaks and gives way. Do the Dow and Russell come back down to earth and join the S&P and the Nasdaq back inside the range, or does the S&P futures break out and then eventually we see the Nasdaq join and in the parade to the bull side, making higher highs and higher lows, and perhaps even seeing something of a new trend form. Don't see that quite yet, but certainly that side is gaining momentum compared to the bearer side. Let's take a look at some of the other markets. Crude oil decidedly weak and has been weak going into the election and then weak since the election. And with last night's activity, we broke through the 618 Fibonacci retracement. So unless we get a pretty immediate resumption by the bulls to take this back up, I would imagine that we'll probably go all the way down to 39 and change with a 100% fib retracement. So pretty remarkable that we hit a new 52-week high, and that was done on 10/19. And just about everything since then has been negative, and that we could be going all the way from 52 down to 39 in relatively short period of time. So the crush has been on for crude oil, and you really don't want to get in front of that negative energy until you have a confirmed bullish reversal signal. And in terms of others, gold also quite negative and has definitely broken down below its support levels. And the next obvious support target isn't that much farther away, about 1200. Likely we'll see 1200. And again, much like crude oil, very negative energy. And you don't want to get in front of that, trying to go bullish until you are in a confirmed reversal signal. Bonds also have been very, very negative. Again, all three of these markets, very negative energy. Don't be looking at bullish intermediate term signals until you see a confirmed reversal signal. And then let's see here. Let's go to the dollar. Let's see what that's been doing. Dollar, as you might expect, with the weakness in the bonds and gold and crude oil, the dollar has been heading towards all-time highs, and in the overnight last night came relatively close to its all-time high. So continued strength on the dollar. And then volatility, of course, has been getting crushed. It's up a little bit today, and you see an overall, it's about a 15. That's kind of smack in the middle of what we think of as the bullish range. So not much to make of this at this point. We'll have to start to see if we can see any kind of pattern start to form. Right now, the primary story is the vol crush since the post-election. I suspect that volatility is not gone. There's a lot of sorting out, and certainly every single time the new Trump administration makes a report as to composition of its cabinet, how it might handle policy in the first 100 days and so forth, that reverberates through the respective companies, industries, and sectors. So they'll likely continue to be, especially on the company level within with key industries and sectors, some reverberation as this policy starts to become better understood. And that's where we are right now. We're trying to understand where this might lead. And as some of these leadership decisions are starting to solidify, we'll probably see the volatility settle. But That is not yet the story yet. We're probably going to be in for some more volatility between now and even through the beginning of the year as a result of all of this having to be digested into price. Okay, to the daily report. And things have decidedly changed here in recent sessions. Right now, the intermediate term phase opinions are very bullish. Market phase 2 trend reversal. Our 3 market timing signals are much improved. The first signal has gone to outright bullish, confirmed uptrend coming to us from IBD. The second one, GMI index, is a 5 out of 6. That buy signal has been in place since 11:10. The third one is the messy one, the stock charts decision point scoreboard. While we've seen quite a bit of improvement on the short term, and 3 of the 4 now have bullish signals, the intermediate term is still decidedly neutral at best, with neutral to bear, neutral to bear, neutral to bear, and then mixed signals on the Dow. Also, long term continues to be mixed signals, so this is still a long way from being a nice stack that gives us the feeling of a nice healthy bull market. Overall consensus here on the 3 market timing signals is for a much improved market and a market in transition, and transition heading towards a bullish bias, but not yet having achieved that across all the different time frames. Position sizing opinion is 100% on both models. Intermediate term market posture also much improved, and we are in strong bull on all 4 indices. And in fact, the S&P is close to an 80, and that point it would go to severely strong. And actually, I should have called this on Dow. It is up over 80, a severely strong bull. So you can see the very large contrast from where that was, say, on Monday of last week. Now, this is up against a strong bear sentiment line, so that would seem to be running counter, and these kinds of readings would be prone to failure and rollover against a strong bear sentiment line. So now we did have a trend reversal signal on our intermediate term phase opinion. So the question is are we on a big bounce and then we resume the more intermediate term bearish posture, or do we have a real reversal in place? Now, until we actually see higher highs and higher lows, we won't really know that. And our primary signal does come to us from the S&P, and you see here right now you'd have to argue that we're seeing kind of similar highs against lower lows. So a very, very mixed kind of signal there. Now, if we back up and we look at this and we use weekly candles, then at that point, it's probably, still more of a bias to the bulls, and with some increased volatility in the last year. But that being said, it's hard to say that while we've made incremental new highs, they've taken so long and there have been such subtle differences in between to make too much of the strength of this continuing bull trend. So we've got some mixed signals here that are going to need to be eventually resolved one side to the other. And until we get some concurrence in that, it's kind of tough. One of the things that we look at is the strength of the intermediate trend, and that's fallen below the 80s, so that's currently a weak trend. And that weekly candle chart pretty much shows that, with the most recent year being a very, very weak bull trend at best. In terms of hedge warning status, we did drop another half increment to a level 1. Things continue to settle and improve overall, while at the same time there's still some reason for caution, and there's a number of warnings still in place, and most notably the fact that this stock charts decision point scoreboard has got such mixed signals, and these have been present for quite some time. Until they actually resolve, it's hard to call this by any means a normal bull market. In terms of option strategies, option income strategies, it the VIX is in the acceptable range to initiate new positions. Caution should be suggested, though, while noting that the hedge risk level is decreasing. In terms of covered calls and put selling, both of those are also back in the acceptable to initiate new positions for novice traders. It's a situation really at this point where you're having to find new entry points. And given that we're so close to resistance on the S&P, all-time high resistance, some defensive structures might be considered, a 2-to-1 ratio of low beta, and be selective in your low beta because with the rotation that's currently going on, some of those low beta like utilities have been decidedly negative. Also, this 2-to-1 ratio of in the money versus out of the money strikes kind of go small, go slow, kind of getting and building back in. As you get more confirmation that the bulls are truly in control, you add more. So that's kind of the position that we're in at this point. Same thing with put selling, acceptable for new positions, but keep them in a position size that you're willing to own. This market's not yet settled one side or the other. In terms of specific warning areas, you can see this is greatly improved and really only 2 warnings left. Actually one, this 125, this has dropped below 120 now. So the only warning left is the distribution day count with the Nasdaq at an 8 and the S&P at a 5. If the S&P trawls to a 4, that will go off warning status. So you see we continue to see these warning statuses go back to normal. Under the trend-based, all 3 of these are in normal stance. Now, intermarket risk aversion indicator is interesting enough. We had one push back off to risk off. So we'll have to see if that's just a wiggle and comes back and joins the other 4 as risk on, or if that's just the first of the 5 that's starting to now go towards the risk off. So we'll watch that, but that was a new signal to the risk off or to warning status. In terms of sentiment, quite neutral. In terms of sector-specific action for Friday, you see consumer discretionary, tech, industrials, financials were all positive. Overall day was relatively scratched, though, and you could see for the most part, none of these numbers are particularly large, with the exception of materials, healthcare, and energy, all more than 1% down. In terms of market postures, we're starting to see some separation between those that are in favor and those that are not. And you see, of course, utilities, we've been talking about that being down. Consumer staples have also taken quite a hit of lately. And, of course, technology have been taking a hit. So you see that reflected across the 3 time frames. And you also see in terms of the 1 day, 5 day, 1 month, 3 months, you know, there's been some change in direction. So not a lot of consistency yet. Big inflection points occurring with the post-Tuesday election results. And until we start to see these settle into higher highs and higher lows, it's difficult to make too much of it until we start to see something of some duration and persistency actually achieving something. Now, some of these, of course, have moved significantly since the election. So in pockets, there certainly is achievement. But in the big picture, the S&P, we're still kind of essentially back to where we were before the election started to get weaker. And let's go back to the daily. And you see, as before the FBI announcements came in and so forth, and things started getting weaker, you know, before the election period itself, we were basically right here in the same place. And the price is currently just right back to where it was in the early September time period. So until we actually break to one side or another, we're still in the range. Okay, that's probably enough for today. Let's go ahead and wrap up. We're a bit over 20 minutes, as is sometimes typical of a Monday. But disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here tomorrow morning for the next session with the market preview from Falcon Global. In the meantime, manage that risk, and you'll see that consistency build, and seek to learn something each and every trading day about your craft. Good trading.